The Ford stock price has plunged 40% over the last 5 years, and new car sales just hit their lowest in 6 years last quarter. I found a few reasons, though, that could push shares up 20% or more in the next year on top of Ford's huge 6% dividend yield. I'm doing a complete analysis of Ford shares today on Let's Talk Money. Beat debt, make money, make your money work for you, creating the financial future you deserve. Let's Talk Money. Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Those of you in the community know I love deep value dividend stocks, and few are as deep value as Ford Motor Company. With the share price about a tenth of what it was in 2011, I think there's a lot of upside in one of America's oldest car companies. In fact, I recently put Ford in a 7-stock portfolio of must-own dividend names and added it to our 2019 Stock Market Challenge portfolio. In this video, I'm going to be explaining why I think Ford could turn around that 8-year losing streak and how high it can go. Now, I'm excited to do this Ford stock analysis. It's a level of depth that I don't usually get to here on the channel, but that's where I'm from. I want to reach out again, though, and get your opinion. I could do these in-depth stock analyses all day long. It's what I did as a professional analyst, and I love doing it. I want your opinion, though. What types of stocks do you want me to look at? We could look at sectors like tech, energy, and healthcare. We could look at stocks and specific strategies as well, like growth, dividend, or value stocks. So let me know in the comments below, what types of stocks do you want to see covered here on the channel? Now, Ford has a very tempting 5.9% dividend yield, but it's all been eaten up by a massive stock price loss over the last 5 years. To be fair here, it's not just Ford, but the entire auto industry, with that First Trust Global Auto ETF down 15% over the last 5 years against that tragic 39% plunge in Ford shares and a 48% gain in the S&P 500 over that period. But that dividend isn't the only thing attracting investors to the shares. This graphic shows the price to earnings on Ford shares over the last 3 years, and trading for as low as 6 times earnings and as high as 10 times earnings over that period. Their shares now trade for just 7.8 times the company's earnings over the past year, but what the chart doesn't show is that if you go back to 2014, it was trading at over 115 times earnings and even higher than that just after the recession. In fact, shares reached $99 in 2011, 9 times their current price. Now, I'm not saying that Ford's stock price will ever be anywhere near 115 times earnings again, or even half that, but this stock is definitely in deep value territory. Now, earnings are expected almost 4% higher over the next year to $1.35 a share. Revenue, on the other hand, is expected to remain a little sluggish at $144.9 billion. That's about a 1.1% decrease from the sales over the last 4 quarters. Now, if we go back to that chart of the earnings estimates for Ford, though, we see that results have been all over the place. Now, this isn't like what we'll see in Apple in our next video, where management has done a really good job of managing and then beating those earnings expectations. Ford has missed earnings expectations in 3 of the last 8 quarters, but has also beaten big time in a few of those quarters as well. So it's a little harder to estimate what Ford's earnings are going to be because of that inconsistency, but we're going to be talking about that massive 63% earnings beat last quarter and what to expect over the next year. So any way you slice it though here, Ford is a value stock, but the problem when you're investing in these deep value names is always going to be timing. Shares have been plunging for the better part of 8 years, so why should we think that Ford can turn it around now? Question here is, will Ford continue to drop, or will it be like those shares of Hanesbrands, ticker HBI, that top performing stock in our 2019 dividend portfolio? Hanesbrands had been falling since 2015 with a 65% slide through last December, but has since rebounded more than 50%, helping our portfolio beat the market. So we first need to understand why the shares of Ford and the rest of these automakers have been plunging, why they might turn around, and are there any catalysts for that to happen in 2019? And this market analysis is probably going to be the most important piece for Ford because of that overall auto market is having such a big effect right now. So on that industry side, the cash for clunkers and other post-recession programs led to a surge in new car sales from 2010 through 2015. During this time, new car sales rose from just 10 million units to over 18 million new cars sold every year. The problem is that sales in the US have just tanked over the last 3 years. Sales of cars and light trucks were down 2% in 2017 and flat last year. J.D. Power reported that first quarter sales for 2019 fell below 3 million units for the first time in 6 years. Now, higher prices have helped to moderate some of this volume decrease for the automakers. The average new car price hit a record $33,300 this year, but that's also contributing to part of the problem. Since wages haven't really increased, lenders are having to extend out loan terms to 72 months to keep those monthly payments low for buyers. That helped to encourage sales, but it can only go so far. So what we're seeing is this massive wave of new cars that were bought just after the recession. These cars are now in the used car market and are really weighing on those new car sales. There is reason to believe that Ford can come out of this crisis though, and management is making those tough decisions to turn it all around. Management has done a pretty good job of cost cutting, but knows it has to do more from here. The company has gone from making cars on 27 different platforms in 2007 to just 9 platforms today, which gives it a lot more flexibility and efficiency in that production model. Ford has a solid year planned for product launches, including the Explorer and a new Super Duty truck later on in the year. We've already seen some really good numbers from the launch of the Ranger, and then the company's most profitable model, the Ford F-150, gets a redesign next year. Those first quarter results were a huge surprise and started to show that the company's 3-year restructuring program is finally taking effect. Now, earnings before interest and taxes, so that EBIT measure, jumped in the first quarter to $2.4 billion from just $1.4 billion last quarter. A lot of this was on that big move in profitability from just 3.5% EBIT margin to 6.1%, which is a huge move for just one quarter. Now, this is all part of a 3-year plan to shave up to $25 billion in costs off the bottom line, with full benefits expected to be realized through 2022. So even if that overall market for new cars doesn't improve, we could see some stronger earnings from Ford. Now, for its dividend, Ford generally pays a 15-cent per share payment 3 quarters of the year, then declares a larger dividend in the January payment depending on cash flow. On that industry weakness, it didn't do that this year, and we'd probably be safe to assume that it won't do that next year either. That should still mean a 60-cent per share dividend payment in 2019, which is still nearly 6%, though it is quite a bit off of that 85 cents per share paid in 2016. Now, we see here that Ford has been pretty sporadic with its dividend payment, growing the payment in 3 years and then dropping it in 2 of the last 5. On that current dividend, the company is paying out 65% of its net income. Now, that's a level that's probably not sustainable over the long term. I know a lot of analysts like to point to solid free cash flow reported, but if you remove other cash payments like pensions and separations, the actual cash flow comes in just below that $2.4 billion needed to support the dividend payment. Rock bottom interest rates have helped Ford and these other automakers stay afloat, but the company has borrowed a net $47.7 billion over the last 5 years. Now, this is where it really starts to get a little scary for investors, because the company owes over $100 billion in long-term debt, more than twice the market value of the shares. Now, Ford does have $34 billion in cash on the balance sheet and $80 billion in other current assets, so that's likely enough to support the dividend and some of these other cash costs around the restructuring program for a few years while the company works its way to better profitability. Over the long term, there is reason to believe that Ford is further along in electric and autonomous vehicles than the market has given it credit for. The company plans on launching a fully self-driving commercial truck in 2021 and is developing a Level 3 autopilot system for consumer vehicles. The company is also launching a Mustang-inspired crossover electric vehicle with a 300-mile radius in 2020, as well as an electric version of the F-150 soon. Management expects to have a lineup of at least 40 electric vehicles by 2022. Now, putting all this together can give us an idea of where that Ford stock price goes from here and some price targets. First though, if you're liking the video and the information, do me a favor and tap that thumbs up button below the video. Now, Ford is a pretty widely covered stock with 12 ranked analysts offering their targets. Tate McKelly of Citigroup has the lowest target at $10 a share and a hold rating right around where the current price is. John Murphy at Merrill Lynch has a buy rating and the highest target at $14 per share. Now, I think Ford could run to $12 a share and even higher over the next year, barring a big drop in the economy. There's a good chance the earnings surprise to the upside for about $1.50 in profits per share, and it would only take an 8 times PE ratio to get to that $12 target. With this kind of improvement in earnings and profitability, investors would come back in a big way and push the shares even higher. Now, I'm linking here to a new dividend portfolio I just created. If you want your dividend stocks to pay your bills, click to the video on the right. 7 dividend stocks that will put cash in your pocket every single month. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.